Hello, everyone, and welcome to our annual financial reporting webinar, getting ready for our 30 June reporting season. I'd like to start by acknowledging the Wurundjeri people of the Kulin Nations, who are the traditional custodians on the land on which George and I are both coming to you today. And I pay my respect to elders past, present, and emerging, and acknowledge their ongoing connection and care for our lands. I'd also like to acknowledge the traditional owners of the lands on which you're all joining the call today, and I extend that respect to any Aboriginal and Torres Strait Islanders on people on the call today. Apologies for that. So welcome to our annual IFRS update. My name is Kristen Haynes. I'm our National Head of Technical Accounting, and I spend a lot of time working with all things to do with accounting standards, corporations acts requirements around financial reporting, and I really enjoy helping our audit teams, our client teams and our clients themselves deal with their technical accounting issues. I'm joined today by George Darkis, the Chair of the More Australia Audit and Assurance Committee, and I'll let George introduce himself.
Good morning, good afternoon, good evening to everybody, wherever you are coming to us from. As Kristen said, I am the Chair of the Audit Committee, but also a practicing audit practitioner for my sins. So hopefully today is going to be a combination of the technical standard requirements as well as a practitioner's view of life as well. So looking forward to the session. So in terms of what we're going to cover today, so it's going to be quite broad, but what we're trying to do is really make it as specific as possible to, I guess, our client base as well, and the various industries in which our clients sort of sit. And really what we're trying to cover is the new requirements for 30 June 2023. It's not too dramatic, which is good. So the requirement to have stable reporting is actually coming through. But there are some key changes that we do need to talk about and that will have immediate impact. So we'll go through those. We'll go through some IFRIC agenda decisions, and believe it or not, some of the major changes in financial reporting actually coming out of other bodies and other organizations, not just the accounting standards. So for instance, a couple of years ago on decisions around SaaS and cloud reporting actually came through decisions that were being made rather than changes in standards. So we'll go through that as well. We'll have a look at what the regulator, both ACNC and ASIC and other regulators are talking about and focusing on in terms of financial reporting. One, in terms of historical changes that have been made, and two, what the horizon looks like in their eyes and how we need to take that into account as well. We want to then cover some hot topics around common mistakes and common areas that we're still seeing in financial reporting or accounting for financial reporting matters, and sort of go through those and illuminate those. And then we'll have a look at what are the standards or changes or reporting regime changes that are going forward into the next number of years as well. So I'll hand it over to Kristen and we'll get the ball rolling.
Excellent, thanks for that. And just before I progress any further, if you do have any questions for us throughout the session, please submit it in the Q&A window, and George and I will be able to see them throughout the session. We may stop for some questions if they're particularly on point as we go through. Otherwise, we will set some time at the end aside to try and deal with some of your questions. All right, so let's get started with the new requirements for this 30 June. And as George has alluded to, thankfully, it's a nice short list this year. We just have two amending standards, one which is a series of minor annual improvements, and the other one which is an Australian specific amendment. And all that is actually doing, as the name suggests on the right there, is introducing some more illustrative examples for not-for-profits for revenue recognition. And that was particularly around things like joining fees for schools. So I'm not going to talk about that one today. It doesn't actually change the requirements at all. With regards to the annual improvements, I've got the amendments listed there on the slides. The first one is to AASB 1, which is first time adoption of Australian accounting standards, which it's a minor amendment anyway, and not many of us actually go through that standard, so I won't talk about that one. The amendment to AASB 3, our business combination standard, again, is just a change in a reference to the conceptual framework, so it doesn't fundamentally change the standard. AASB 9, financial instruments. This is a slight amendment around when you are modifying a loan, how do you do that test as to whether that modification is substantial or not? And it just clarifies that you just need to consider payments made between the borrower and lender and not payments made to third parties. AASB 116 is our PP&E standard, and this is around where you have PP&E that is not fully installed and ready to go, but during that calibration, I should say, phase, you are still producing some products and selling the output that you're generating, and there's some guidance around that one. The second last one there, which apologies, I've just noticed a typo on the slide. The amendments to AASB 137 around calculations on onerous contracts. I will go through in the next slide. And the final amendment there is to AASB 141, which is agricultural assets. And this is the standards just actually catching up with practice. So the standards are now saying that you can use post-tax cash flows in fair valuing your agricultural assets, which from my understanding is what most valuers were doing anyway. So let's have a bit of more look at our onerous contracts. So this is an amendment to AASB 137, our provision standard, and it's around how we test for what is an onerous contract. So, and when we have onerous contracts, that means the costs to fulfill that contract are higher than the economic benefits we expect to receive from that. And the actual wording that the standard has in it is you need to include the unavoidable costs of that contract. And there was a lot of diversity in practice as to what people actually considered to be those unavoidable costs. Some people considered it to be just the incremental costs of fulfilling the contract, and other people included those costs and also included an allocation of other costs that directly related to fulfilling the contract. And what the International Accounting Standards Board came out and did was clarify that, yes, you do need to include both of these components. So let's have a look at what this will actually mean. So if you considered your unavoidable costs just to be those incremental costs, this might include costs such as specific tools to fulfill that contract, the materials used for that contract, or contractors specific to that contract. And because onerous contracts tend to be related to long-term larger contracts, these are the sort of things that we'll often see. But if we take that view that it's just incremental costs, we'll compare it to the economic benefits of the contract, which is typically for a sales contract, just the revenue you expect to receive. And you can see in this example, it's still, the economic benefits are still higher, and therefore we don't have an onerous contract. However, once you take the view, which is what the standard is now requiring, and include the full direct costs, which include an allocation of other costs such as permanent staff, equipment costs, depreciation, any other cost that can be attributed to that contract, you'll see that you've got much higher unavoidable costs. The economic benefits of that contract haven't actually changed. Therefore, under this interpretation, it's much more likely that you're going to have onerous contracts. So in the current economic environment where we've got rising costs, this is going to be a real issue for companies because I would expect to see more onerous contracts this year anyway. And now with this amendment that is clarifying that we need to include more costs that we may not have been including previously in that assessment, I think it's just one further indicator that you're going to see those rising costs. Any builders on the call in particular, this is one to consider because as most of us would be aware, a lot of the home builders have fixed price contracts where those costs are increasing. So these are the sorts of issues that all the home builders around Australia are seeing.
And I think, Kristen, what we're also seeing is other areas like retail, supply-based agreements that have been entered into over a number of years. So it's a bit broader. So we're seeing a lot more sort of occurrence of these types of arrangements that might have been entered into a number of years ago, and with the turning economy, sort of brands itself a bit broader than just what we used to think about in the past. So it's something to be mindful of.
Absolutely. So the next thing I wanted to talk to you all about was the IFRIC agenda decisions. So IFRIC is the Interpretations Committee of the International Accounting Standards Board, and it's really important that we stay on top of the IFRIC agenda decisions, because IFRIC agenda decisions have the same level of authority as the standards themselves. And to be in compliance with IFRS, you need to be in compliance with the IFRIC agenda decisions as well. And unfortunately, with the IFRIC agenda decisions, there is no extended application period or transition period for these. You need to apply them as soon as practically possible after an agenda decision has been made, and they consider that to be a matter of months, not years. So you really do need to understand what's going on. For the next little section, because this is coming from IFRIC, I do tend to refer to things by the international standards, but I will try and compare them to the Australian ones as well. So these are all the IFRIC agenda decisions that they've made in the last 12 months. A lot of them are quite specific to industries. There's a few there around insurance, which are not going to be relevant to a number of our clients. And then there is also some around SPACs, or special purpose acquisition companies, which are a very specific type of investment vehicle coming out of the US. However, the two that I want to focus on today is where a lessor forgives lease payments, and how the requirements of IFRS 9, so financial instruments, and IFRS 16 leases actually interact, and also how we define a lease and where we have substitution rights. So the question that was put to IFRIC with regards to the lessor forgiveness of lease payments was, how does a lessor apply the ECL requirements, so the doubtful debt requirements of IFRS 9, and the lease modification guidance of IFRS 16, so our financial instruments and leases standards, to a rent concession granted in an operating lease where the only concession was the forgiveness of lease payments, some of which were contractually due but not yet paid, and others that were not yet contractually due. So we have some lease payments that we have currently sitting as a receivable on our balance sheet, and some others that will occur in the future, and the lessor is going to forgive those. So what the IFRIC did is they looked at this in two steps. So they said the requirements of the financial instrument standard as they relate to impairment does apply to the recognised lease receivable. And that would actually apply before the rent concession was formally granted. So if you know that there is a possibility that you are going to forgive those lease payments in the future, you should already be reflecting them in your impairment calculation, because that ECL calculation is forward-looking. So any expected future reduction should be reflected in that calculation. Once the rent concession has been formally granted, you would then de-recognise the amount that has been forgiven from those recognised lease receivables. The requirements of the leases standard, IFRS or AASB 16, would then apply to the remaining lease payments. And what that would mean is that you would recognise the new lease payments in a systematic, generally straight line basis over the remaining lease term. Therefore, if you have forgiven the next 6 months of the lease payments, and then the lease payments continue for another 18 months after that, that 18 months of lease payments would actually be spread over the 24 months. So you keep recognising it on a straight line basis at a lower amount. So the second one is around what is a lease, and is there a time where we can get out of lease accounting? So in this one, we had an arrangement where a supplier provides 100 batteries for electric vehicles for the next 10 years. The supplier has the right to substitute those batteries at any time over that 10-year period, but it's only financially viable for the supplier to replace them after year 3. And 2 questions were asked. What's the unit of account? What level do I determine whether I have a lease? And is the fact that the asset is substitutable mean that there is no lease? So the first question, I'm not quite sure why this one went to IFRIC because I feel this is fairly clear in the standard, but IFRIC did confirm that you need to look at it at the individual asset level. So there is 100 separate potential leases here, and that's the way you should always look at any sort of lease arrangement. The second question is around the substitution rights. So the definition of a lease does say that if an asset is substitutable, then it doesn't meet the definition of an asset because there's of a lease because there is no specific asset that you have got the rights to use. It talks about there being substantive substitution rights throughout the life of the lease. Well, they did say that having substantive substitution rights throughout the lease does not mean that you have to have substitution rights at every single moment throughout that lease, and judgment will be required. However, in this specific fact pattern, given that it was not financially viable for the first 3 years of the lease, 3 years out of 10 is a substantial length of time, and therefore you could not say that there was a substantive substitution right throughout the majority of the lease, and therefore this would meet the definition of a lease. So that's all the real changes that we need to think about for this 30 June from an accounting standard perspective. So it's nice to see, as George said, we've got a bit of stability. But I'll now pass over to George and he can have a bit more of a look at the ASIC areas of focus.
Fantastic. So every year or every 6 months, ASIC release their focus areas. But in the last couple of months, there's been quite a lot of information coming in and out of ASIC, and you probably would have seen in the press over the last month or two various issues around reporting, valuations, and other issues that are affecting financial reporting and all being reviewed by the regulator as well. We've actually got a very good summary of this aspect of in terms of regulatory changes and other changes that are occurring in financial report on our internet. So if you want to see the detail, please go to the internet, search up ASIC review processes, and you'll see that on the internet. We'll give you a bit of the detail and where this information is coming from. But what we want to do is touch on, I guess, the high level aspects of their concerns, the impact that will then have on financial reporting, and then of course as auditors, what we're going to be expecting to see in financial reports for 30 June 2023. And the heading says December 2022, but that should really be June 2023. So it's as recent as a few weeks ago. Let's start with the asset value. So there's quite a lot of discussions around impairment of non-financial assets. So we're talking about your goodwill and your intangible assets, your contract assets and other assets in there. And there's a lot of focus on ASIC from an indicator's point of view, and looking at the model, and particularly with the changes in the economy, the interest rate rises, which Kristen will talk about in a moment too, in terms of the impact that that's going to have. There's an expectation that there's going to be an impact on models around impairment for non-financial assets. So there's a real emphasis on the key assumptions being used, the WACC that's being used, the actual valuation methodology that's being used as well. And specifically for probably maybe the first time, there's been a lot of discussion around market capitalization. So if you're a listed company, often auditors or financial report preparers would use market capitalization as almost a substitute for a valuation model. Whereas ASIC are coming out now and say, well, no, it's an indicator model. And it might be something that you can check against, but it shouldn't be the basis of which you look at your recoverability of your non-financial assets. So it's not about using market capitalization rules or asset values to determine impairment. So there's a lot of focus on there, and there's a lot of disclosure needing to be required around that. And we'll talk about disclosure in a second as well. One of the other key issues that's popping up from a regulatory point of view is the value of property assets. And I know that even within our practice and other individuals, we've been talking a lot about property asset values. And given the incremental change in interest rates and WACCs and yields and recoverability, there's a lot of discussion about, commercial and retail assets and what their values are. But there was an article that was out a couple of weeks ago, I think, in the press, and coming out of ASIC, really challenging valuers and challenging their methodology and challenging their assumptions around how they come up with values, property value assets. And I think as auditors and preparers, they're really on notice in terms of making sure that we are, I guess, sort of forced and diligent in challenging valuers' assumptions and valuation methodology in terms of property assets. So really, really watch this space and be really mindful about the disclosures and the key assumptions around valuations and in the financial report to cover that. ECL and expected credit loss matrix methodologies around loans and receivables is also another area that is of focus. And I think the bit that a lot of preparers of financial reports and maybe even auditors have sort of missed is with the changes around this matrix, it's now about looking forward as opposed to just looking back at historical. In the past, in the last few years, we used to look at the historical value of your debtors, for example. So we would look at the portfolio of debtors and say, okay, what do we expect within those debtors to go bad? Now it's really looking forward and saying, well, what does the future hold? And given the economic climate that we're coming into, there's going to be more and more pressure around getting that right and challenging that in terms of a futuristic look at it. And even more specifically, looking at it from an industry or sector specific basis as well. So within your client base or within the client base of a client, in terms of its debtors, well, what sectors do they play in? And are they more susceptible to risk and loss from a receivables point of view? And we'll talk about an example a bit later on, how ASIC have forced changes in financial reports. Values of other assets, but predominantly around unlisted investments. So we've seen over the last few years, but particularly a lot of companies investing in other non-listed entities or unlisted vehicles, a lot of startups, and placing a value on those is becoming very difficult. There's a group called the International Private Equity and Venture Capital Association, which has actually put out a valuation guideline. And to my clients and to our clients that have unlisted investments, we really encourage them to use those guidelines in terms of valuing emerging businesses and startup and venture capital businesses, which tends to be the issue. One, because they don't have DCFs that you can rely on. And two, it's building principles around which you do the valuation. So look out for that if you're not using it at the moment. The next part is around disclosures. And one of the key things that comes out from ASIC's view in terms of the disclosure part is in this operational and financial reporting aspect of it. So it's about disclosing information to the user, which is actually really valuable to the use of to the investor. And we're talking about, the drivers of the business. We're talking about key risks, cyber risk, climate, sustainability, ESG. And particularly there's a big focus from ASIC in terms of, well, what are the risks that the organization is focused, and how are you dealing with those risks, and how are you mitigating? ASIC acknowledges, the regulator acknowledges that clients talk a lot about the future of the business and how great the future looks, but what he doesn't do is talk about the risks associated with those future strategies. So a lot of that, the disclosure part is around identifying those, disclosing uncertainties, disclosing judgments, disclosing, I guess, the negative impact of what the future strategies may actually hold, and making sure that your asset and liability classifications are appropriate, they're current and non-current, and they reflect the true nature of the asset liability that you have. Non-IFRS information that they look at and focus on is just to make sure it's not misleading. And we'll talk about an example a little bit later. I'll give you an example of where they've asked a company to restate their financial report, but it's about not misleading the user. It's about not being overzealous on the future and being appropriate. So don't make motherhood statements in your financial report that can't be substantiated and that might be misleading. And the same thing for half-year reports as well. So on the right side is then talking about, so some of the sort of segments you can look at is really focusing also around subsequent events, the clarity around those subsequent events and identifying those and disclosing those in the accounts, the uncertainties and risks which we sort of talked about, and also moving towards solvency and going concern, which is another major area for them, and making sure that there is clear guidance, clear statements around it, and the judgments and estimations that have gone in relation to the solvency or going concern aspect of it. And in relation to provisions, we just talked about onerous contracts, making good provisions, restoration provisions, and financial guarantees are sort of other areas that ASIC are talking about focusing on that as well. Greenwashing was another one that was also mentioned, which they've actually released a report in May 2023. It was called the ASIC Recent Greenwashing Interventions Report. And they basically, in that report, they looked at greenwashing. And greenwashing is basically making claims about climate that you can't substantiate. And I think, Kristen, you might talk about that a bit later on. But from a regulatory point of view, they made 23 corrective disclosure outcomes through their review. They issued 11 infringement notices and 1 civil penalty proceedings against companies that failed to, who made outlandish statements around it. So in terms of enforceability, we'll quickly just look at this, but ASIC is serious about certain things, and one of them is non-lodgement of financial reports, and you'll see there was about 16 companies that were prosecuted for not lodging financial reports, and they received fines and other penalties as well. But on top of that, there's also what we call Section 311 requirements of auditors to report companies who continuously don't report. And there's also the tax disclosure regime that are in place. The second aspect there is they talked about business risk disclosure of listed companies. And again, I'll talk about an example a bit down the track. But again, it's, as I mentioned before, is what are the key risks of your organization, and have you adequately documented those around the estimates and the judgments and the risks of your business within the financial report as well. And the last one is just around significant reporting, numerous restatements. They've forced companies to restate. An example is, for example, Southern Cross Media was asked to remove non-IFRS profit measure. So just as a mouthful, Southern Cross Media disclosed a profit line on the profit and loss, and it was called profit before depreciation, amortization, interest, impairment, fair value movements on derivatives, and income tax expense for the year from continuing operations. So when you look at that as a line, ASIC didn't like that because in their view it was misleading and it was providing information that wasn't really adding value. So they made the client or the company restate its financial report and remove that from it as well. Look, they're probably the key things to be mindful from an ASIC perspective. I'll hand over to Kristen to go through the AC&C considerations.
Thanks for that, George. So AC&C, there's probably 2 things to be mindful of. One is some new related party disclosures, which we'll go through in a little bit more detail. And the other one is similar to ASIC. They have been really cracking down on charities, who have not been lodging their annual information statements or annual financial reports, and they have cancelled the registration of over 700 charities this year for failing to lodge their annual information statements. We also found out that in the federal budget, AC&C did get some additional funding to use for regulatory activities, and they are going to be publishing more guidance and more findings of what they're finding when they're going and looking at charities. So that's going to be really interesting to have a look at as it unfolds over the next year. So related party disclosures are now going to be required for all charities from the 30 June year end onwards. So if you are a small charity and you're not actually preparing financial statements, you do need to provide some qualitative disclosures in your annual information statement. So you don't need to quantify these disclosures, but you need to make sure it's clear where you've got these related party transactions, and so users can understand how they might impact your organisation. For the small charities, they have simplified the definition of a related party, and it really looks at those who are on your board or the trustees, depending on how you're structured. And the family members that are closely related to those. So it's a very simple definition of just looking at those who are charged with governance of that organisation. If you are a medium or a large charity, if you're preparing general purpose financial statements, then you should have already been providing the related party disclosures. However, most of our charities do still prepare special purpose financial statements, and the ACNC has now clarified that related party disclosures will be required in those special purpose financial statements. You have to apply the full definition of a related party that anyone in the for-profit space would already be familiar with. So this isn't just those charged with government and your key management personnel. It also involves other entities that you may have operating relationships with as well. So it's a bit broader definition. I would say for most charities, KMP are going to still be the key so the key management personnel are going to be the key individuals and related parties that you need to think about and their close families. Because we are within the accounting standards here, these are going to be both quantitative and qualitative disclosures as they're required in AASB 1060, so the Simplified Disclosure Standard. The disclosures required in that are, if you are more familiar with the full disclosures in AASB 124, they're fairly similar. So that is something, if you haven't already thought about, you do need to look into for this year end. So that's all we wanted to talk about on the regulators front. And now we just wanted to have a bit of a look at hot topics. And I think, George, the biggest one of these is probably just the current economic environment, if you want to talk about that in a bit more detail.
Yeah, so I guess the first part, so there's, given the current economic environment, the change of interest rates, the removal of government subsidies and so forth, we're starting to see a bit of a change in the economy, the impact it's having on clients. And there's a few sort of impacts that it's going to have on balances, which Christian will talk about next after this part. But the key thing for me in the current environment is really the impact of budgeting and forecast and what that is going to have and the impact that's going to have on various balances. One of the key issues, when we talked about the ASIC regulatory reviews that have occurred, a number of the intangible assets, for example, were written off or required to be written off by various companies and being forced by ASIC to do so, was around the budget and the forecast process and the impact that has on impairment testing and other balances. So I can't underestimate the importance of budget and forecasts at 30 June 2023 and going forward. I think in the past, and given what we've sort of gone through, there was a little bit of, I guess there was a focus on it, but not to the degree or the extent that we expect to occur going forward. As I said before, the ASIC write-offs that were required was around the unrealistic nature of some of the forecasts. And sometimes when we go to clients and we look at forecasts and we do impairment testing or we look at going concern, there's a real sort of push and emphasis on how realistic those forecasts are. What are the inputs in relation to those forecasts? How can they be backed historically? And if it's a forward-looking type of forecast, well, what contracts are in place? What customers are in place? What distribution outlets are in place? And where is the cost management exercise that is being undertaken by the organisation? So from a preparer's point of view and from an auditor's point of view, we need to spend a lot more time around the controls and the mechanisms of establishing the budgets, establishing the forecast and the linkage between various balances. So for example, sometimes we see the forecasts that are being used for impairment testing is different to the going concern testing and maybe also different again to the testing of a deferred tax asset or losses that are being capitalized in the financial report. So the ability for it to be consistent throughout the organization and one set of forecasts and budgets is going to be a really critical aspect of it, because the change in the economy and the change in interest rates and so forth are going to have an impact on the future and the future estimation and the growth rates and the WACC that is being used in particular, if you're trying to validate assets, but also importantly, go into your going concern assumptions and the uncertainty and the risk disclosures that we talked about before that need to go into the financial report, because a lot of your risk and assumptions and bases will come out of your budget and forecasting. So I'll leave it there for this aspect of it. But as I said, it's really critical and it's really important as auditors and financial report preparers that we really think about the forecasting this year, in particular, because it's going to have an impact on various balances. So back over to you, Kristen.
Thanks, George. So rising interest rates, high inflation, and the potential that we could be heading for some financial difficulties, which is what I think a lot of economists are sort of forecasting, could have a lot of impacts across your financial statements. So things like debt covenants, if you have got an interest coverage ratio in particular included as a debt covenant, well, you might start finding that with rising interest rates and reducing profits, for example, that interest coverage ratio gets much more challenging to meet. So you might find that you do struggle with some of your debt covenants, and I'll go and talk about what you need to think about with waivers on the next slide. We've really touched on valuations. George talked about the impacts it might have, but it's not just impairment of your non-financial assets. It's going to impact anything that you need to do a fair value of. So we're talking our investment properties. We are talking about assets held for sale where you're trying to measure them at fair value. If you've got agricultural assets, a whole range of assets do actually rely on fair value measurement. And so you're going to need to think about how that needs to amend from prior years. And you really need to probably not just assume that nothing's changed. Onerous contracts I've talked about earlier, but they are probably more likely in an era of rising inflation. Expected credit losses, because they are forward-looking. You can't just assume because you've never had losses in the past that things are continuing to be rosy going forward. And so if your expectations are that things are going to be tough for the next couple of years, then it may be that you need to have a higher impairment provision. And again, your assumptions that you're using in building that ECL calculation should be consistent with the assumptions that are going into other valuation models, such as your going concern, such as your impairment of non-financial assets. Held for sale. Well, the biggest one here is really around the appropriateness of calling something as held for sale. And for something to be classified as held for sale, you need to expect that that sale is going to be completed within the next 12 months. In the current environment, how comfortable are you that the sale will be completed within the next 12 months? Is it appropriate? Does it meet that definition? Similar to onerous contracts, the net realizable of your value of your inventory may need to be reassessed. You might have inventory, costs are rising, inputs are rising of that. You may not be able to pass those higher costs onto your customer. So you really need to consider whether your inventory needs to be written down to that net realizable value. The useful life of PP&E, so our property, plant and equipment, really is an interesting one. And it might not be something that you initially think about that the impact of rising interest rates and inflation will actually have. But if you have got a piece of PP&E and you assumed it was going to have, its useful life was going to run out next year, you might sit there and actually be going, do you know what? It's going to cost a lot more now to borrow money to replace that piece of equipment because both the price of the new equipment has gone up significantly and so has the interest costs of borrowing. So do you know what? I'm not going to replace that piece of equipment next year. I am going to let it run for a couple more years before I replace it. So you do need to think about the useful life of your PP&E and your impairment estimates and consider whether those useful lives are still relevant. Business combinations have all sorts of considerations. Obviously, you're fair valuing everything on that acquisition, so that's going to be affected. But things like contingent consideration is also going to be an issue. How likely is it that people are going to actually meet those hurdles that you've set in contracts? How is the change in economic conditions actually driving those, and what reflections do you need to make for those in your financial statements? Finally, where you have inflationary clauses in your revenue contracts or your lease contracts, they're probably the ones you most often see them in, but I guess they're obviously going to be in supply contracts as well. You really need to think about specifically what your clause is and how it affects your accounting, because it is going to be quite bespoke, but I would just encourage you to think about those contracts. So I talked about debt covenants and how they are likely to be a lot more challenging to meet this year. And I think it's not uncommon for our clients to try and get waivers from their lenders around their debt covenants, because a breach of a debt covenant will mean that your debt has to be classified as current. So if you have tested, if you at balance date, your covenant has failed and you want to get a waiver from your financier, you need to make sure that that covenant is received before balance date. If you do not receive that covenant until after the year end, because you've realized, oh no, I have breached my covenant. So I go to the bank and go, oops, sorry, can you help me out? If you receive the covenant at the after year end, that is not going to change the classification as at balance date. The conditions that existed as at 30 June were that you were in breach of that covenant. Therefore, that debt needs to be classified as current. You can disclose as a subsequent event that you have got that waiver, but it will not be able to make the debt classified as non-current. What needs to happen? If you think you are in risk of breaching a covenant this 30 June and you don't want that debt to be classified as current, what you need to do is speak to your bank in advance and receive from them prior to balance date a legally enforceable waiver from testing that covenant. So it needs to be not, oops, you've missed that covenant, don't worry about it. It needs to say, you do not need to test this covenant, or we are not concerned if you breach this covenant at 30 June, and we will not call this debt if you breach this covenant at 30 June. But it needs to be legally binding and received before 30 June. So an email that from your banker, from your relationship manager at the bank that says, they don't think that should be a problem, it is not legally binding. It needs to be something that we as auditors can rely on and show that there is no risk of this debt being called. So it's really important that you get that in place, because I think it's something that we have conversations with clients, I think every year, who receive that waiver after balance date and really don't understand why they can't have it as non-current. So you need to have it received and be legally binding prior to balance date. All right, now, George, do you want to go through some of these other common errors that you have seen as you've been talking with clients?
Yeah, well, let's have a look at some other sort of common areas that we're seeing in financial reporting. Just to reiterate the bank covenant one, that's a very common, should probably actually be on this list as well. And the other aspect to that too is sometimes and often in loan contracts, there is a motherhood statement that allows the lender to actually call the loan for no reason, for any reason whatsoever. And sometimes that's not picked up, and organizations believe that they have a right to defer, but in fact, they don't have a right to defer. And that can also change the classification too. So that's also a common error that gets picked up. But just quickly on some of the other ones, some of them we've covered, so I won't go over those again, but make good provision still is a key area where there may be a make good requirement on a lease. but it's just not being accounted for as part of the lease accounting and the provision requirements of the standard too. So if there are make good provisions within a lease agreement, it's important that they are reviewed and analysed, and appropriately, if required, a provision needs to be brought to account. Just because it's difficult to provide for something or estimate something, it doesn't mean you don't bring it to account. So we're still seeing a lot of the make good provisions occurring. The effective interest rate method, we're still seeing a lot of errors in this area. So for example, if you obtain debt and there's a cost to obtaining that debt, historically, we used to capitalize that cost to obtaining that debt and amortize it over the loan period. And that's not the correct way to do it. It's the easiest way to do it, but it's not quite the correct way to do it. You have to offset it against the loan, calculate your effective interest rate method, which will be slightly higher because now you've got to recover the costs of obtaining that debt over a period of time and recognize the interest portion at the higher or effective interest rate method than you would have done before. So if you are obtaining debt and there is cost to that debt, chat to us about how to appropriately bring that to account. Related party transactions is, again, we've talked about that, but there's still a lot of debate about what is related party transactions or what is a related party. And because of SDS implementation this year, if you were doing a special purpose financial report before, you never really had to worry about related parties. But now we're seeing a lot of that discussion. So just being aware of what is a related party and what needs to be disclosed in your financial report is important. And then what processes are in place by the client to actually pick up, or the organisation to pick up related parties. And I just refer you to an RG76 related party transactions, which is issued by ASIC. This is ASIC's view about what to do with, how to capture and how to manage related party transactions. It's targeted towards listed and managed investment schemes, but for larger corporates, it's actually a very good document to sort of get a bit of a feel for appropriate governance around related party transactions. Impairment of receivables, we've done to death, we've talked about it. The matrix is still a big issue. It's something that's very rarely done, and we have to sort of force the conversation. There was a situation with a company called Emeco, E-M-E-C-O, which is basically a rental company for earth moving equipment. ASIC on their surveillance made them actually create a provision for doubtful debts because they didn't have a matrix model in place to the tune of $22 million. And it was about the futuristic possibility of a customer not being able to pay their debt. So it's also the matrix, and the thinking about the matrix is also still a common error that we are seeing. Back to you, Kristen.
All right, thank you. So that's really all you need to be completely mindful of for this 30 June reporting season. But there is one change in the accounting standards that's coming in next year, which I think is really important to get our head around now, and that's to do with the current non-current classification. And then the other thing on the horizon that I want to talk to you a bit more about is sustainability reporting as well. So in the past, there's two forthcoming requirements, but I only want to talk about one of them. So there is an amendment around deferred taxes, which relate to assets and liabilities arising from a single transaction. And so what I mean by that is if you have a lease and you recognize a lease liability and a right of use asset on your balance sheet. So you have deferred taxes relating to both the lease liability and the right of use asset. Some organisations would have offset those and only recognised a net tax position. What this amendment says is, no, you have to recognise it gross and have your gross DTL and DTA relating to each of those separately. So leases and provisions are the two areas where that's going to have the biggest impact, and that's applicable next year. But the one I want to spend the most time on is the classification of liabilities with debt covenants. So there is two amendments here that you need to be aware of because the first amendment caused some confusion. And so this time last year, I think I was talking about how the IASB were going back and having another look at it. And that is where that second one in the green box there has been issued. So in the First Amendment, which I think initially would have been applicable for this 30 June, but the IASB and subsequently the AASB has pushed the application date back. They made this amendment that you see on the slide, and it's really this Section D there that talks about an entity does not have the right at the end of the reporting period to defer settlement of the liability for at least 12 months after the reporting period. If you don't have those conditions, you need to classify something as current. And it went on to talk about the treatment of debt covenants. And it basically said if you're in breach of any debt covenant at balance date, even if you weren't due to test it until some point in the future, you had to classify that debt as current. As you can imagine, nobody really liked that as an answer. So the IASB went away and had a look at it. And what they've come back with this Second Amendment, they have said that if you have a covenant that you do not need to comply with until after balance date, that will not impact your classification as at balance date. So the requirement to meet a covenant in some point in the future does not impact your covenant, your classification as current or non-current as at balance date. However, what the IASB has said is to explain the risk to users and to be clear the risks that you are facing. They do want more details about these covenants. They want to know where you have covenants, what the liability is it's associated with, and any facts or circumstances that may indicate that you're going to struggle to comply with those covenants and you may have issues in the future. So that includes anything you have done during the period to mitigate a potential breach, which would include I went and got a waiver that was legally binding before balance date, or if you would be in default if you tested it at balance date. So I'm going to take you through an example because I think that's actually going to be the easiest way to understand this one. So as at June 2023, which is our balance date, X has a working capital ratio of 0.9. It has two loans, both of which require a working capital ratio of 1.0. For loan A, X must test and report its working capital ratio by the 31st of July based on its 30 June balance sheet. For loan B, it must test its working capital ratio on 31 July based on the balance sheet at that date. So for loan A, I think this would probably be hopefully fairly familiar to us. We're testing this based on the terms and conditions that existed as at 30 June. Therefore, we've failed the test at 30 June, we've failed it in the current period, and we had to test it at that date. You would need to classify that debt as current. So for loan B, again, this is probably what you would have expected. It's sort of, they've gone around in a circle in some ways. Because you only have to test it based on information at a future date, which is based on the balance sheet at 31 July, it can still be non-current even though you failed the test at balance sheet. However, what will be new is you would need to provide those additional disclosures that I mentioned on the previous slide, including acknowledging that if you had to test it as at balance date, you would have breached the covenant. So it's being much more open and transparent around your financial risks associated with those loans. The other part that came through with this initial modification around current, non-current classification was around convertible notes. And the convertible notes, the current or non-current classification of convertible notes is not impacted by a conversion feature if that feature is equity classified. And this is a part that I think everyone got so swept up in this covenants piece that everyone is forgetting this separate second element to the amendments. So if we look at another example, so X has issued now two convertible notes that are both repayable in 5 years' time. Both notes are convertible into equity at any time at the investor's discretion. The conversion feature on Note A is equity classified, and the conversion feature on Note B is a derivative measured at fair value through profit and loss, so it's liability classified. So convertible notes are always quite messy, and I sort of don't want to go into why something's equity classified or why the conversion feature is derivative classified. But you need to look at the specific facts and circumstances. So just for this example, just assume however the conversion features are structured, we get one that is equity classified and one that is considered to be a derivative. So both of these, though, have a host liability. So the convertible note principal is going to be a liability on our balance sheet. The question is that liability current or non-current classified? So for note A, because our conversion feature is equity classified, we don't need to think about it. And all we see is that we have a note that is repayable in 5 years' time. Therefore, we can classify this note as non-current. And I think in reality, that's what everyone would probably be doing with these convertible notes at the moment. Note B, which is the interesting one, the way this amendment works says, well, because the conversion feature is debt classified, we need to consider the terms of that when we're classifying the host instrument. Because the investor can demand settlement at any time, even though that settlement is from the conversion to equity, it is considered settlement of that debt. Therefore, you would need to classify that principal as current. That could be quite a large change for some organisations who have issued convertible notes, and it's not something anyone currently thinks about when they're structuring these instruments. So really, even though this isn't applicable for another year or two, if you are thinking about issuing any sort of convertible note, convertible preference shares, I'm not really fussed what you call them, something with a conversion feature in it, you may want to seriously think about the implications of doing that and what it might do to your balance sheet, because it might be quite a significant current classification issue. So the last topic I wanted to touch on before we open it up for questions is sustainability reporting. So we do have a couple of questions in there, but if anyone does have anything they would like to ask, please add it into the chat box. So sustainability reporting is becoming my new hottest topic, and for very good reason. By this time next year, sustainability disclosures and sustainability reporting is going to be legislated in Australia, and some entities are going to be about to enter into their first year of application. So yes, we have been talking about sustainability for a little while, but we really are now getting to the pointy end where we really need to start acting on this. So where we are at, in the next couple of weeks, we are expecting Treasury to release a position paper. My understanding of that position paper is if it is not actually draft legislation, it's going to be very clear what their expectation is around what the reporting regime is going to look like in Australia. We are expecting on the 26th of June that the International Sustainability Standards Board, so that's the sister board of the International Accounting Standards Board, is going to finalise their sustainability standards, and we are going to have those global standards. The AASB will then release them in Australia as exposure drafts, but it's expected that we will get the final standards issued in Australia by November. In early 2024, we expect the legislation to pass Parliament to mandate this. And then, as I said, the first lot of reporters will be reporting from 1 July 2024. So June 2025, you'll have phase 1 reporters, and then June 2026 will be phase 2 reporters. We don't know exactly who phase 1 and phase 2 will be and who's going to be mandated reporters yet. Treasury did put out a consultation paper just before Christmas, and they sort of asked what people thought about who should be in phase 1 or phase 2. I think there is a possibility that phase 1 reporters might only be large listeds, but there was some push as well for it to be all listeds, and then with some unlisteds coming through into phase 2. So I would tell you more about that if I could, but it's really wait and see. But when that Treasury position paper does come out, we'll definitely put out some communications for you. All I really want to say in the sustainability reporting space at this point is please just keep up with it. It is going to be happening very fast now, so you need to be aware of what's coming. The other thing is that sustainability reporting is the absolute end of your journey. Sustainability reporting is about reporting how you manage climate risk in your organization. Just because we're not reporting until June 2025, June 2026, doesn't mean we don't need to start worrying about it now. I would really encourage you to start that journey now. Start thinking about what your risk management processes are, how climate risk fits into that, how you monitor it at a board level, what you're doing, how it's affecting your business strategies, because that's all the piece that has to happen before you can start reporting. So this isn't something you are going to be able to wait till the end, or your sustainability report's going to look very sad when you say, oh, we don't do anything on climate risk. We don't really think about it. So really encourage you to start having that conversations now and thinking about it, and chatting to your advisors is a great place to start. We've got a team at Moore who is able to help you have those discussions as well. So the key takeaways from today is really, I think about the current economic conditions. If I think about what George and I have spoken to, a lot of it really comes back to those current economic conditions and how they're going to impact your financial report. Things like your onerous contracts, yes, it's going to be driven by the changes in the standards, but it's also driven by the economic climate. Always keep on top of the IFRIC agenda decisions. If there are ever any key ones, we would put publications and guidance out about them, but do try and stay up to date with them. If you haven't already got your financial reports in for the last couple of years, I would really encourage you to get on top of them and get them finalised, because we've seen that ASIC is really cracking down on that. Make sure your debt covenants are in place prior to 30 June, so you can keep things classified as non-current. And as I've already said, really watch out for those sustainability reporting developments, because it's going to happen really quickly. George, did you have any other key takeaways there before we moved on to questions?
Oh, no, I think that certainly covers it. And I guess the key thing for me is just to understand that the market and the economy has changed quite substantially. And there is an expectation that financial reporting and disclosure will increase in relation to that. Should be a bit more skepticism around balances and provisioning, and the requirement to really put risk into your financial reports so that the report can actually be useful to a user. Because clients often talk about the great stuff, but they don't talk about the judgments and the estimates and the risks that a financial report should actually have.
Excellent. So I do have a question here that we've received around the onerous contracts, and when does that requirement to include the fixed costs within your onerous contracts provisions actually start? That was applicable. It's definitely applicable for 30 June this year. I think it was applicable 1 January 2023. So it would have also already been applicable for December year ends last year, and it's definitely applicable for year ends this 30 June. So any onerous contract calculations that you're doing and assessments needs to include the allocation of fixed costs come this 30 June.
And also, Kristen, in relation to transition requirements, so it might be, what do we know about the transition requirements from, this new interpretation of it? That might be an existing contract that might be 4 or 5 years old that now might be onerous. I believe there are transition requirements.
Yeah, I don't think there's any requirement to go backwards and change your onerous contract assessments in prior periods. It is any assessment done from this 30 June onwards, is my understanding of it. Yeah. All right. There's a couple more questions, but they're quite bespoke and specific to individuals, so I might not actually touch on them in the call. But thank you all very much for joining us. I hope you have found this session useful. We will be sending out to you after this call our technical update. That includes all the standards that are mandatorily applicable for 30 June, including their transition requirements, and all those standards that are available for early adoption. And we have just shared the link for that as well for you in the chat. But thank you very much. If you have got any further questions, please feel free to reach out to George or myself, or to your local Normal More Australia contact, and they'd be happy to help. Enjoy the rest of your day.
Enjoy the rest of your day. Cheers.